Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Volatility 75 Index, also known as the VIX 75. This is a synthetic index that is renowned for its high volatility, offering unique opportunities for traders who understand its dynamics. We will break down the Volatility 75, how it works, and provide you with a step-by-step strategy to trade it effectively with. So stay tuned to learn how to navigate this exciting market. You start by understanding what the Volatility 75 Index is about, and it is a synthetic index designed to measure the market volatility. It reflects the degree of uncertainty or risk in the market, making it a popular choice for traders who thrive in dynamics condition. Unlike traditional assets like your stock or forex pairs, the Volatility 75 operates independently, stimulating price movement based on volatility rather than underlying economic factors. Now, this index is characterized by its high level of activities, meaning price movement can be rapid and significant. Its values These values is measured on a scale of 1 to 100, with high numbers indicating higher volatility. For example, during a calm market condition, the index tends to remain below 20. However, in turbulent times, it is often exceeding 40, signaling higher heightened market strength. You would also notice that the Volatility 75 frequently follows trend for extended periods. It follows trend for extended periods. This means that once a direction is established, whether the market is going upward or downward, it tends to persist, offering opportunities for traders who can identify these trends early. However, this same volatility also apply risks, so it requires careful analysis and risk management. Another unique aspect of the Volatility 75 is its accessibility. Unlike traditional market ties to specific hours, this index operates 24 hours. This flexibility allows you to trade across different time zones and respond to the market changes whenever it occurs. However, activities level can vary throughout the day, with peak volatility often aligning with major globe trading sessions. Understanding the behavior of the Volatility 75 is essential before diving into the strategy. The movements are influenced by factors such as the market sentiment, geopolitical events, and economic data release. So positive sentiment generally keeps the volatility low, while negative sentiment drives volatility higher as fear increases in the market. Now let's see the step-by-step trading strategy for the Volatility 75. Now the scalping strategy for Volatility 75 index focuses on capturing small price movement in a short time frame. The approach is to minimize the market exposure while allowing you to take advantage of the index fast-paced volatility. It relies on precise entries and exit points confirmed across multiple time frames to ensure accuracy and reduce the risk of losses. We start by setting up our 15 minutes time frame to detect potential signals. Apply indicators such as your Bollinger Band. We apply our Bollinger Band to this strategy. We also apply our RSI indicator, our stochastic oscillator, and our MACD. These are the major indicators we will be using for this strategy. Now, each indicator serves its own specific purpose. Like The Bollinger Band measures the volatility, the RSI highlights market exhaustion, the stochastic oscillator tracks momentum while the MACD confirms the direction. So now for a buy signal, if you are looking for a buy signal, first things first, you would have to look for these conditions for a buy signal. The stochastic oscillator must reach the level 20. The stochastic oscillator must reach the level 20, and as you can see at this area, it is at 20. So this is the area that it is at 20. The RSI has to touch level 30, and as you can see, the RSI touch the level 30. Okay, here it did not touch the level 30, but as we can see at this area, it touched the level 30 at this area too. But let's stick to this. It reached the 30 region. Now we have to also look at the MACD histogram forming a drought. As you can see, the MACD histogram at this level was forming a drought. That means it was dropping a little, or showing signs of exhaustion at this area. Then we have to see price has touched the lower Bollinger Band, and as you can see at this area, price was at the lower Bollinger Band. So this is showing that there will be a sign for a buy trade. While for sell signals, for selling signals, the first signal we will see for a sell trade, the first signal we will see for a sell trade is that the stochastic oscillator has reached the level 80, and as you can see at this place, the stochastic oscillator is at 97, so it is above 80. Now the RSI touches the level 70, and as you can see, RSI is at the 70 region in this indicator. It's at the 70 region. Now the MACD histogram has to form a peak, and as you can see, the histogram is forming a peak at this area. As you can see the histogram, this is the peak at this area. Now price has to touch the upper Bollinger Band, and as you can see at this same area, price is at the upper width of the Bollinger Band. So these are the conditions for a selling trade. Once all these conditions are met on your 15 minutes time frame, you have to draw a straight line to mark and anticipate the reversal point that will help you visualize your potential entry zone for further confirmation. So this is where we are going to align all of that. And as you can see, this line has aligned all to confirm it is above 70, it is above 80, it is at the upper Bollinger Band for a sell trade, and the MACD is at the peak of the histogram. Now this is where you would want to take a bearish trade to capitalize on the scalping move. Now once you have aligned everything there, you switch to your 5 minutes time frame to confirm your signals. Now if all the condition align with your 5 minutes as they did on your 15 minutes, mark it as a potential setup. If it does not align, discard the trade and wait for another signal. So before you take your trade, you would have to go to your 5 minutes time frame, that where we have marked with our horizontal line, if it aligns with the same analysis from our 15 minutes time frame. And as we can see at this area on the 15 minutes chart, you can see first of all, first things first, the Bollinger Band, it is at the upper width of the Bollinger Band. As you can see, our stochastic oscillator is above 80 at this region. Our RSI is above 60 at this region, and our histogram, MACD histogram, is at its peak. So this means that all four indicators align, and this would have been a perfect entry for a sell trade. Now before entering your trade, after confirming, you can also check your higher time frame like your 1 hour to ensure that the short term prediction aligns with the overall trend. So because most times the higher time frame shows a stronger momentum in the opposite direction. So to avoid entering a trade that will be a fake out, you can check your 1 hour time frame to see if it's aligning with the overall market. And as we can see at this point in time, we are expecting a pullback after the market has broken to the downside. So it aligns. Now when you are placing your trade, always remember to use a stop loss to avoid premature entries, so that when you enter the trade prematurely, you'll be stopped out at a small risk. Instead of losing all your account, you set your stop levels just below a recent low in a buy trade and above a recent high in a sell trade. You can use support and resistance to determine take profit and aim for favourable risk to reward areas. So if we are to take a sell trade at this area on the 5 minutes time frame, we'll put our stop loss just above a recent swing high, and as you can see, this is a recent swing high at this area. We just put our stop loss at that side, then we would aim for a minimum of 1:2 or 1:3 as the case may be. Now finally, you have to monitor your trade slowly and exit when price has reached a key level such as the middle or opposite Bollinger Band, or when the indicator shows signs of exhaustion. This disciplined approach will ensure you capitalize on small price movements while minimizing your risks. Never forget that you will not risk more than 1 to 2% of your trading capital on a single trade. This will help you ensure that you do not risk all your accounts, because this pair is very volatile. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I'll see you in the next video.